Okay, so we're looking at the World Bank's gold and silver outlook running through 2027. The goal here is really to sharpen the analysis, make those forecasts more robust for an expert audience. We'll jump right in. The basic picture: gold hitting a peak in 2026 around $3,575 an ounce. That's about a 5% gain. But then, straight away, a pretty sharp drop to $3,375 in 2027. And silver follows, dropping almost 10% that same year. Now, the interesting part is this volatility is supposedly happening on, well, a very strong foundation. The analysis keeps stressing the market will stay way up, like 180% above the 2015-2019 average.
Right.
So the first big area we think needs attention is that really sharp pivot in 2027.
Yeah, exactly. The sharp pivot and decline projected for 2027, coming right after that 2026 peak, it just demands a more developed explanation for the causes, especially when you contrast this, short-term dip with the very strongly argued long-term high base.
Let's unpack that tension a bit. The report does a good job establishing the structural stability, that 18% premium you mentioned. But then it throws in this significant 2027 decline without really spelling out what fundamental shift, macro or geopolitical, justifies such a, sudden U-turn after a strong run-up.
Precisely. And that leaves the investor feeling, uncertain. What's the actual trigger for this correction? Right now, it kind of looks like noise, especially when everything else points to structural strength. So the weakness is that missing link, that defined mechanism strong enough to push against the structural supports they've built up. How could they integrate that better? What are some ways?
Well, one way is to explicitly connect one of the downside risks they already listed, say geopolitical easing or maybe tighter monetary policy, directly to the mechanism causing the 2027 price drop.
Okay. For instance, they could state that the $3,375 projection hinges entirely on, say, the resolution of conflict X, and then maybe briefly explain the degree of easing needed to actually trigger that 5% drop in gold.
Got it. That gives the number real predictive weight, and maybe also give some context for how big this drop actually is.
Oh, absolutely. Contextualize the severity. We're talking 5% for gold, nearly 10% for silver. Compare that scale and maybe the duration to historical post-peak corrections in precious metals. Is this dip just, a normal pullback after a big run, or is it unusually shallow or unusually sharp, given the rally size? That kind of historical benchmarking tells the reader whether to see it as consolidation or something more worrying.
Right, that makes sense. Defining the trigger, contextualizing the scale. Okay, building on that need for defined mechanisms, let's pivot to what feels like maybe the biggest structural change happening right now. The report rightly points out the, quote, unprecedented central bank buying tempo. That's the key thing separating this rally from, say, the 1979-1981. If this official sector buying is the defining structural feature, it really needs to be woven more systematically into the whole risk picture.
Yes. While correctly identifying this unprecedented buying as a differentiator, the analysis should more systematically integrate how this structural factor influences the robustness of the long-term price floor. Right now, it feels like central bank buying is flagged as historically different, but then the risk analysis and the numbers seem much more driven by the old familiars, USD weakness, geopolitical flare-ups.
Yeah, it's a bit like saying we've discovered gravity works differently now, but then calculating trajectories using the old Newtonian physics. If this official buying creates a genuine new structural floor, then how long it lasts or how strong it is, that has to deeply shape the 2026 and 2027 outlooks.
That's the disconnect. Precisely. So the suggestion is use the unique nature of this sustained central bank demand to establish a much clearer structural floor in the analysis. Show exactly how this official buying maybe dampens the volatility we usually see from those traditional safe haven flows.
Okay, so how could they actually quantify that? Put a number or a clear assumption on that structural commitment within the forecast itself?
And the implications are pretty big, right? If a central bank is buying for strategic reasons, like, long-term diversification away from the dollar, that kind of buying is inherently less jumpy, less sensitive to short-term geopolitical news than, say, hedge fund money.
Exactly. So if the base case assumes sustained central bank demand, The analysis has to explore how that makes the price potentially less vulnerable if geopolitical tensions ease. It might even partially counter the listed downside risk. Ah, interesting.
Yeah, imagine if they could segment the forecast. Show that even if tensions ease, taking away that feared premium, the structural bid from central banks maybe prevents the price falling below, I don't know, $3,400. Now that's powerful, specific insight for the reader.
That kind of integration moves the forecast beyond just tracking conflict headlines. It lets the reader think about outcomes based on longer-term policy trends. That's a significant upgrade in predictive power. Okay, let's switch gears slightly now to silver. It presents a really interesting puzzle because of its dual role. Right, the analysis notes silver's projected to rise, 7.9% in 2026? Actually outperforming gold's 5% forecast, and that's driven by both investment demand and industrial needs, renewables, semiconductors, those fast-growing sectors.
Correct. The robust analysis of silver accurately notes its dual role, safe haven and essential industrial input. But it could benefit from a more focused prioritization, maybe even quantification, of which role is expected to exert the most significant price pressure, especially in the near term.
Yeah, I think the conflict is quite clear. The report acknowledges this steady, growing industrial demand, solar panels, chips. That suggests a stable, maybe rising floor price. But then silver is projected to drop almost 10% in 2027. That volatility feels very much like it's just mirroring gold, which is purely a safe haven play.
That's it. The apparent stability on the industrial side seems logically at odds with that prediction of extreme volatility driven by, say, geopolitical easing. Why does that stable, fundamental demand suddenly get overridden so easily? The analysis needs to resolve that tension. So the actionable suggestion here is clarify the interaction between those two demand drivers. If industrial demand is really projected to grow steadily, the analysis must state explicitly how this fundamental demand either mitigates or perhaps fails to mitigate that expected safe haven-related decline in 2027.
Okay, and how could they put some numbers or structure around that relationship? Give us some concrete examples.
Well, first, they could break down the growth. For that 7.9% forecast in 2026, maybe offer an estimated split. How much of that growth is expected from industrial demand versus investment demand? Just seeing that ratio immediately clarifies what's driving the train.
Right.
Second, focus on that floor effect. If industrial demand is robust and growing, maybe suggest a scenario where that stable demand creates a stronger floor for silver compared to gold. Logically, that might lead to a more moderate decline in 2027 than the nearly 10% currently projected.
Or alternatively, if they really stand by that severe 10% drop for silver, they need to offer a very compelling, explicit reason why that fundamental industrial stability, which is, critical for the energy transition in tech, why it fails to cushion the blow from the safe haven pullback during that specific period.
Exactly. It's either a misjudgment of the industrial floor's strength or the anticipated geopolitical unwind is just so overwhelming it swamps everything else. Either way, the rationale has got to be laid out clearly.
Excellent points. So we've landed on 3 really high leverage areas for refinement here. It feels like the core theme is moving beyond just reporting the forecast numbers to really explaining the structural mechanisms and the interactions between the drivers that produce those numbers.
That sums it up nicely. The 3 key actionable steps to strengthen this analysis are: first, clarify the mechanism for that sharp 2027 reversal. Link the drop directly to a specific defined downside risk and justify the scale of the correction against historical patterns. Second, fully weave in the structural impact of central bank buying. Quantify the assumption about its persistence and show how it potentially builds a new price floor, maybe mitigating traditional risks.
Got it.
And third, for silver, refine the forecast by prioritizing and quantifying the impact of its industrial versus investment demand drivers. Really resolve that apparent conflict between the stable industrial base and the projected price volatility.
Great. These suggestions feel very targeted. They should help move the analysis from being a generalized forecast to something more like a predictive model that readers can really engage with. We definitely encourage you to work through these strategic adjustments and please do submit the revised material back to us. We'd be happy to take another look.